Mish, you're doing some navigating here to get to us. Michelle Schneider, Chief Strategist, Market Gauge, FinTech Publisher, commodity trader, former floor person. We love to have floor people on here. So big windstorm knocked out the internet at her house. She scrambled and made it to her office, Mish. We really appreciate you coming on today.
Thanks, Joel. Good to see you all.
All right, so you got we're gonna deviate a little bit from the Modern Family a little bit, and with the PCE number coming up momentarily here, let's talk about some macro and the yields you could get in the market, the potential for stagflation. Mish, how are you sitting on these issues?
Well, not much has changed really in terms of my overall feeling about what's going to happen over the next couple of years. And now I think we have more evidence. Obviously this rally that we've seen in the tech rally has been spectacular. And so there's always, and I was listening to Dennis and Mitch talk about this, there's always the opinion and the macro, and then of course then there's the trader mentality. And so as the trader mentality, it was a spectacular rally and we were able to take part in a lot of it. And that's simply because of the math. There was absolutely no emotions or thinking about it. It was following the models. And I believe that that's who did better this year, is the people who just said, wow, this is going up. I don't care why. I'm just going to buy it. And so I wanted to follow up on what you guys said before because I was listening. And it's so true. And that's why Apple at 191, people are going, damn, why didn't I buy it when it got over 175? Well, 175 was a huge breakout. So a lot of people still at this point, and particularly institutional investors, I'll get back to my point about stagflation in a moment. I just wanted to follow up on that.
I appreciate it.
Yeah, are either they've missed this rally, and so now FOMO, as you were mentioning before,
Mm-hmm.
and on the same token, it's a rally that's not stopping, at least not yet. So now let's go back to stagflation. Does the tech rally really represent growth? We did have a decent GDP, 2%. It's nothing expansion, but it's at least not contraction. And I think that's really what brought us the first 6 months to this point was A, there was a feeling that inflation might have peaked, and we'll get back to that. B, tech area was actually relatively undervalued coming into this year. C, there was an overall sentiment that the Fed was going to at least, maybe if not even pause, at least slow the rate of how fast they were going to hike. And really the champions of all of this are the consumer, because the consumer has been going out spending money regardless of all the doom and gloom out there. So that has really brought us to this point. So that makes me question, is that optimism going for the next 6 months going to continue? And we can already see evidence that maybe not. This yield curve is inverted to a point that it hasn't been since 1983. That generally means at some point there could be recession. People were expecting it right away. We have earnings season coming up. I'm thinking maybe we don't even see recession, at least in the actual terms of recession, for a while, because we still have to go through this stagflation, which means right now, with the Fed saying they're going to raise and inflation not really going away, it tells me that if they're more aggressive, we'll have to go to a stagnating part, and eventually, they will have to do something more aggressive to get that job market being a little bit weaker so that they can then possibly put us into the recession. And that's where we're at right now. So if that's the case, this big tech rally will be impacted, but that doesn't mean that there won't be a good rotation into other opportunities.
This is a good segue here. And what I've been noticing over the course of the last few weeks is this rotation. The IWM has started to show life. IWM trading at a multiple much lower than the S&P, not trading even close to the 30 times earnings that Apple is trading at here right now. I mean, half of that is really where the IWM is. Small caps have been absolutely forgotten. People are like, why would you buy small caps when Apple's going up 20% a month? I mean, at a certain point in time, could there be a catch-up trade? And I am, full disclosure, very long the IWM. Could there be a catch-up trade here on small caps? Because they have underperformed here for a very long time.
Well, that's such a great question, Dennis. And of course, it's also a good segue for me because IWM, the Russell 2000, is still the granddaddy of my economic modern family for this very reason, is that if you really want to see what the impact of everything that has happened with inflation and with central bank policy, you have to look at the Russell 2000 because that's going to be the reflection of what's going on within the United States. Are we really growing here in terms of these companies? Now, I will get arguments on that. People say, oh, you should be looking at the S&P 600 instead of the Russells, but the charts are virtually the same. So to answer your question, all of the tech areas, and NASDAQ and SPY, the Dow, semiconductors, and now even transportation, and that's the key here, another member of my economic modern family, as is semiconductors, they've all gone through this 23-month moving average. And I believe when I was on last time with you, I showed you that because it's a very important measure of a 2-year cycle within a longer cycle. And so we needed to see that get over the 23-month to show some level of expansion. And here we are, right? That's why we're seeing the 2% GDP. But IWM has not. It has not cleared it yet. It comes in at around 190 to 193. So to your point, Dennis, if it can get through there, then I would think that, right, we're going to see not only more of the rotation into the small caps and into the value versus growth, but it will be a true sign of healthiness for the market and something to actually look forward to, which of course would then spur more confidence from the consumer and then maybe bring back some of the money that's still on the sidelines into the market. So we're at a very close to a very critical point with that Russell. And we too, by the way, are along the Russells once it got over 180.
All right, Mish, let's pivot here and talk commodities, right? And we had big perception, commodities, big run, supply chains, wheat's going to 20, soybeans going to 30, everything got really out of proportion. We've had a pullback. Wheat is really pulled back. Corn is hold tough. So, but just overall, looking at, the underpinnings of inflation are commodities. What is your take on the commodities markets for the remainder of the year?
Well, the commodities market, Joel, as you know, are very volatile, and that's what they are. And if we think that we're in some level of a similar period to the mid to late 70s, this is exactly kind of what happened. There was this huge run in 76, particularly if we look at something like sugar, which you know is my great barometer. And then it came off like 40, 50%. And it was the same thing. The Fed actually relaxed at that point some of their tightness that they were doing. And then, of course, then we had that great bull run that happened in 79. So we're a little bit different here because the Fed is aware of this. But if I do believe still that these commodities are not done because not necessarily of the technicals, nothing really much has changed except for the fact that supply chain has eased somewhat, but we still have Russia. I mean, this weekend, everybody thought that, we were going to go into some kind of civil war in Russia, and then that didn't happen, but that doesn't mean that there isn't going to be Russian headlines coming out. We still have a lot of problems with weather. I mean, you mentioned at the top of the show that we were going to do this for my house this morning, and I came here because there was no internet. Well, the whole entire country has been experiencing either extreme drought, or when the drought alleviates, it becomes these flooding rains, and that's going to affect the crops. China's having a major drought. Australia's had a drought, although I think it's been a little bit better lately. All of these things, along with higher interest rates, we have not seen the reduction of the costs when you go out and shop or you go to a restaurant. So the raw materials, that tells me that they've sold off from a technical standpoint, but they're still relatively rare, which is why these companies are charging higher prices, which is a lot of what's interesting about the PCE coming out today. So the very short answer is this, now that I've kind of given you the backdrop, is I still believe we should not get complacent about these commodities.
I agree.
I think DBA took this incredible run from 21.
I remember you talking about that. Yep.
Yeah, and then it got to 22, which is exactly where it needed to go, and went all the way back down broke down under 20, is now back over 21 this morning as I looked before the market. And this tells me that you got to keep an eye there, and there could be an opportunity. And we're talking grains. If we look at industrial metals, steel's been going up.
Yep.
You know, Tesla's made deals
Mish, I hate to cut you off, but we got an 8:30 number.
Oh, is it out?
It's coming up right now. So we're going to go do quick coverage of that. And I really appreciate you coming on. We're going to get you on again real soon. Everyone's like, have Mish on for the whole hour. So we're going to wrap things up today. Mish Snyder over at Market Gauge, guiding us through the market. We really appreciate it. We'll dial you up again soon.
All right. Thanks, Joel. Sorry I went on too long. There's a lot to say.
Oh, it was my fault because I ranted too long.
Yeah,
before
Dennis is throwing us out, man. He's
fired. Get her back on next week.
Dennis
We got to keep
Mish
going.
in.
Mish in, yeah.